We've focused a lot on the fundamentals lately, so let's take a look at the charts with Carter Worth, CEO and founder of Worth Charting. Carter, great to have you here at the desk.
Thank you for having me here at the desk.
All right, so let's get into the charts. We have the S&P 500 hovering near a record high, and on the surface, the market looks pretty calm, but you look under the surface, right? When you look under it, what do you see?
All sorts of opportunities, but let's start with the market and then we can go underneath. The sequencing of a pretty important sell-off. We sold off January to the March 30 low due to news, I guess you'd call it US, Iran. And then we had an incredible April, May rally. 20% in the S&P, 30 in the net, and we've been dead flat since. Yes, we made a slight new high, but that sequence of an important 10% sell-off, a ricochet that recoups all the loss, and then you trade in a tight range. The temptation is to think that it's going to have a big next directional move. The quiet, tight range that we're in, it's the tightest we've been, about 5.5%, 6% range. There's only been 5 or 6 other instances that are this tight over a 2.5 month period going back to 1950. So this is a very quiescent, despite under the surface, to your question, a lot of volatility at the stock level. The aggregate, the S&P 500, is quite dull, has no character. And I think that continues.
So what breaks us out of a quiet, tight range? Does that mean that as we think about where the market goes from here, we continue going nowhere?
Well, so and that's interesting. Even though under the surface it's hyper rotation, so it's highly volatile, but there's no real variance. That's the end. So think about the volatility that we've seen in semis coming off 30, 40, in some cases 50%, and yet coming to the fore to shore up the market because it's just pushing air around has been banks. Right? Broker dealers like Goldman Sachs and Morgan Stanley, or deep sort of out of the money struggling software coming to life. And so, or industrials, or healthcare, which is at a 15-year relative low to the S&P, has been a real favorite of late. And so this hyper rotation is this, and it's the human condition. Let's play semis when they're aggressive. Now they've crashed. Oil went from 50 to 120 a barrel, and then it crashed. Gold was love. Now you can't get anybody to talk about precious metals. Drops 34%. So hyper rotation, asset class-wise, Bitcoin, what have you, or Mag 7, it doesn't matter. And yet the whole, the S&P, the aggregate is flat. And I think you're going to see more. The temptation is always look for direction. Sometimes it's directionless at the macro level. Rates don't seem to move the market, right? There's higher for longer has disappeared from the vernacular. You don't hear it anymore. And yet we've never crossed over 5% in the 10-year yield. Not once. One time intraday, it was October 23rd, 2023, almost 3 years ago. We go slightly above 5%. And here we are, 3 years later, still flat.
When an index is flat, but we're seeing some of these individual stocks or even sectors making these huge moves, what does that tell you about the health of the market then?
Well, to some extent, the market is almost irrelevant, is how I would say. And there's an old sort of oft-used, sort of overused phrase, a stock picker's market. People have used that for a reason. This is what that is, right? Where correlations are sort of low, right? The highest correlations, when the stock market crashes, everything goes to 1, right? Everybody sells everything, right? But right now, correlations are low. And so that is a real opportunity to either find great winners or to mess it up.
Okay, so talk to us about how you're finding some of these great winners, given some of the sell-offs that we've been seeing, but then also the fact that maybe you don't necessarily think that it means we'll move higher from here.
Right. So if you think about of all the factors that have ever been tested, relative strength, momentum, these are the most sort of efficacious. They come back in all tests through time as the ones to favor. And so on a week over week, month over month basis, what is exhibiting good relative strength in a period where the equity market is dead flat? Well, there's certain industrials that have been real laggards that are excellent here, showing all the characteristics that I look for introducing, starting along, or adding along. So for instance, 3M, a fantastic instance, or Boeing, yes, just to name two, and that kind of thing. There's opportunities within healthcare. Obviously, biotech's sort of through the roof, has been very strong, but there are laggards like Bristol-Myers, just starting to carve out a bottom slowly, gradually, deliberately, bottoming, curing, healing after a lot of pain.
We have seen software names rebounding as well. They're well off their lows, but still a very beaten down area of the market. Do you think that the worst is behind us on that front? And where are the opportunities there, if so?
Sure. So if you look at let's take Microsoft, right? The biggest of all. Microsoft has just undergone there's only one other instance in the history of the stock that it had a 30% move in about 2-3 weeks. And that happened at fairly precise intermediate lows and 52-week lows. That sets the low, by my work, for Microsoft, which in turn, add Palantir into that, its strength, that sets the low. So I think the lows are good lows. So this move off of those lows, you can use IGV or some other aggregate to measure software. But the question is, do they have a lot of upside after this fairly impetuous, impulsive bounce? I.e. Microsoft's one of the biggest bounces in the record on a short-term basis. What I would look for within software are laggards, things like Roper, for instance, a fantastic gradual bearish to bullish reversal. Similar to the circumstance where industrials are making new highs, but things like Boeing and 3M are coming to life.
How do you know if the comeback is real, though, versus a head fake?
You can't. Nobody knows. This is not annuities work, right? gotta make your bets and then live with them.
But if a stock is down 20% from its highs, how do you tell the difference between a bargain and a broken
Sure,
stock?
And that's, again, we're looking for that sequence of a protracted decline that then stock starts to stop going down, which is what basing is all about, and then starts to exhibit week over week relative strength that's impressive. But again, valuation has nothing to do with that because that's one of the worst timing tools there is, right? We know and that there is a 100% correlation between earnings per share and price per share on a long-term basis. 3 years, 5 years, 20 years. But there's no relationship at all. 3 months, 6 months, 12 months. Hence, a semiconductor can go up 3x and then drop 50%. Well, the earnings didn't do that, right? There is no relationship between earnings and share price. This month, next month, 3, 6, 9 months.
But on the flip side then, when a stock hits new highs, is that something an investor should fear or that they should buy into?
It's both. It depends on the circumstance. Is it parabolic or is it a gradual, orderly, 45-degree higher, ever higher, north by northeast, gentle? You respect that. That is intact uptrend, stay long, be long. But something that gets parabolic where it starts to almost look like a straight up line. It's not in a chart. It's not going off to the right each day. You shy away from that. Now, can you time? We all try. But look what happened to the Kospi. Again, look what happened to semis in general. Look what happened to gold. Look what happened to oil. Look what happened to Bitcoin. When things get over embraced, over loved, it's usually right to take the road less traveled.
Give us an example of a chart that has gone parabolic that you would stay away from, and an example of one that has, been this orderly increase that you still think is an opportunity.
Sure. Let's take the latter for something like Bank of New York. Now, it's a very steady business, trust, right, and custody bank work, but that's an orderly, stay long, by my work, some might say different. Almost all the parabolic stocks have already succumbed. So there's nothing that's quite still parabolic. Maybe Dell, I might reduce that if one had Dell. It hasn't really come in at all. It's quite extended.
We've seen some huge moves in names like Amazon and Microsoft recently.
Yeah,
actually, if you take a look at those charts, which I can't bring up right now, but you actually see that huge gap, like where they actually jumped. Do you chase that momentum or do you wait for it to come back to you?
So if you think about what causes a gap, right? So here we are on the floor of the New York Stock Exchange. It would be that the specialist would be 934. 942, they hadn't opened the stock, they couldn't match the book. Now we don't get delayed opens, right? Right away, the computers match it and you gap up 4%, 6%, whatever it might be. On the first day of a gap up, it's always news related. FDA approval could be 40% up, earnings beat could be 10. But typically after you gap up, it's a re-rating based on fundamentals, right? Something good has been said and there's momentum drift. But we're past that now with Microsoft. We've had the initial gap and then we've had a second gap. So you don't have price discovery after 1 day of a gap, or 2, or 3 even. But after 15, 18, 20 sessions, you do have price discovery. For instance, we would fade Microsoft here fairly aggressively.
Because,
again, we've had price discovery. It gaps up, why? New news. It gaps up because the denominator changed. They reported good results. And what happens is, it's now cheaper. People rush into the stock. But that wasn't a day ago. That wasn't 4 days ago. That's 16, 18 days ago. You, again, have price discovery. People have had a chance now to exit shorts, to embrace new longs. The committee has met. We should probably put some Microsoft into the portfolio. You've had enough shares change hands that it's now at a level where, again, we would fade it pretty aggressively.
Would you fade Amazon or would you add?
I'd add to Amazon.
Because?
Amazon's not as extended. I mean, it's just a totally different circumstance on the chart.
Okay, so for the everyday retail investor who might be tuning in right here and say, this sounds a lot like trading to me, and I'm a buy and hold kind of person, what's the takeaway for them as they think about what opportunities to add to here, where the market goes from here?
Right. Well, I mean, if you're a trader, it's to trade. The first thing I would say, and it's the only thing really to say, is you have to know who you are in the market. If you trade for an hour or two, then don't ever get off that, right? If you're buy and hold, don't get off that. Stick with your knitting, as the expression goes. Stay in your lane. But that's where it goes wrong. If you're playing for intermediate moves, 2 to 3, 2 to 4 month moves, which are where I believe real alpha is generated, then stick to that. Don't, if it goes wrong, be disciplined with the stops. Don't, if it goes well, I think I'll stay longer. Stay the course, trust your process, but don't change your process.
I should note, this is not an ETF spotlight, but you do have an ETF that I want to mention, the Worth ETF, WRTH. It's basically built for this kind of market that we've been talking about, right? The big moves in individual stocks, the constant rotation and volatility. Tell us, how does your strategy actually take advantage of that?
Right, so it's a fairly straightforward approach. We sell premium. We're in the business of selling out of the money calls and out of the money puts, strangling a stock. The risk with that is one could say, well, you're naked. The stock could, that $100 stock, as an example, could go to 150. You sold the 120 calls and the 80 puts. We're waiting for decay. We're waiting to stay in a range for a very short period of time. But we mitigate the risk of a runaway is that we do it after a company's reported earnings. That's very important. The biggest one-day mover of stocks, outside force majeure, something that's out of nowhere, the chairman's been indicted, or my gosh, the FDA approval did not come through and it's all a disaster. But an individual operating business, an industrial, financial, healthcare stock, the biggest one-day mover is earnings. Earnings are very hard to predict. That's why we get the gaps, right? The sell side is particularly poor at it. So if you only sell after a stock is gapped up or gapped down by 10% or more, and then play for vol crush, this eliminates the risk of having an earnings surprise, the naked call and put. And if you do it enough out of the money, 10% or more after a 10% move, you need a lot of momentum drift to make that wrong on either side. And so we're in the vol crush business. We sell premium and we wait for decay. We sell the bananas we don't own, and then we wait for the spots to start to appear, and then all of a sudden the bananas are black, worthless. That's what we want.
What names are on your radar as we think about the companies that still are yet to report earnings this season?
Well,
obviously NVIDIA is a big one.
Well, that's a big one. And so, for instance, the temptation is, and this is to say, well, we think, who's we? Well, this great team of PhDs in neurosciences, the number one II rank, we think that NVIDIA is going to be good. And we're recommending it to you. Or someone, a trader. The better play, and a lot of astute sort of beta neutral, dollar neutral, long short funds don't do the earnings game because they know how bad it could be if you get it wrong. It's just sometimes a coin flip. Wait for the move in NVIDIA, down or up, and then strangle it. But if you ask me,
it's reactive versus proactive.
Well, or it's what it's doing is it's taking advantage of, after something is re-rated, both bulls and bears believe even more in what they. So that $100 stock that drops to 80, the bulls say this is way overdone. I gotta buy. I gotta buy the dip. And the bears say, we've been waiting for this. It's not down from 180. It's going to 40. So there's still premium out of the money calls and out of the money puts, and then we're waiting for vol crush. I would point out that, of course, we know that 75% of all short-term out of the money options expire worthless. And that's without regard for how much out of the money. If you put it out more than 10% either side and add other criteria, no biotech friends, you can move those odds into the low 90% that you will get expiration.
So basically, you don't have a list that you can give us of the biggest movers you're expecting for the rest of earnings?
You're talking about earnings. We will be very much looking forward to strangling NVIDIA if we get a big enough move, up or down. We don't care about that. And so in that sense, if you think about any investment that anyone has ever come to anyone with, hey, invest in this play on Broadway as an angel, do this real estate deal, buy this stock, go into this fund. They're saying, we think we know the direction. This play is going to be worth more. This bar is going to be worth more. This real estate venture. We're saying, we don't care about direction. After a stock, or most assets, have been re-rated aggressively higher or lower, in a short period of time, they consolidate. Think about how natural that is, right? It's after exerting yourself in the gym, what do? You rest. Exerting yourself in the library, 6-7 hours, if you stay there, your eyes will, you got to take a rest, walk around the block, take a coffee. We play that quiet period. So it's one of the rare moments where we're saying, we're betting that this will go sideways. No one does that. They all are betting, buy it here, it'll go up. Sell it here, it'll go down. We're saying it just did a big up or down. It's likely to be quiescent for the next 15, 20 sessions.
So you don't care about the market direction,
Not
but
so
I
much.
still am going to pin you down and try to get
Let's go.
a sense of where you think this market's going.
Yeah.
Just in terms of when you take a step back and look at the broader S&P 500 and take a look at that chart, is S&P 8,000 likely by year end?
Yeah, but that's very small. Those are small numbers, right? I mean, I think and not to not answer the question, but this is the way to answer the question, is that the principle is the parts compose the whole comprises the parts. We study the whole by figuring out the parts. So let's start with the biggest part of all, semis. If you can figure that out, or then tech in general, that's 30% of the whole, the S&P. So semis, after a sequence of a great run-up, 2-3 years of unrun, and then a crash of sorts, we think that will be very range-bound. In fact, we would go so far as to say that we think the highs are in for the year in semis. So a lot of people are playing for big up, and a lot of bears saying, this is just the beginning, wait till you see what happens. So there's an important circumstance. We don't think semis are a place to be, right? We think they'll be dead. We think software has already bounced so much. Now we've covered 30% of the market right there, right? Because of tech. So the question is, do you go overweight or underweight tech? All towards getting to the answer for the market. We think you underweight tech.
Wow.
Between now and the end of the year. And overweight industrials, for instance. Overweight healthcare. And then how does that all net out as the market? One say, well, if you're underweight tech and tech's 30%, are you saying the market's kind of dead flat? We think, again, that you're not looking at great big runaway moves from here for the S&P, and that it's asymmetrical. There's more downside risk than there is upside potential, I would say, between now and year end.
So underweighting tech, overweighting industrials and healthcare.
Yeah.
What about some of the other, what about energy, for example? Still the best
Energy,
performing year-to-date sector.
So that was the huge winner, right? Outperforming everything, and we know why. Energy was dead flat for almost 4 years. If you look at the XLE, for instance, and then it had one of its biggest breakout type moves on record. Then we get a major give back, but notice how well the stocks are acting, even as oil has come in. We think there's great value, not from a value point of view, couldn't care less about valuation, but there's great value in owning energy as an overweight.
Okay. What else would you underweight here?
I think staples. I just think there's low energy there. They're always sort of dull, but they've well, here's another way to look at it. If you look at the relationship between the Russell 1000 value versus the Russell 1000 growth, value is from the March 30 low. I mean, all equities globally make a low on March 30, right? The Iran, US, and then the run-up since. And the RLV, Russell 1000 value, and the RLG have the same percent gain since the March 30 low. And yet the beta of Russell 1000 value is a 0.71. The beta of Russell 1000 growth is 1.3. So if you do the same performance and your beta's almost half of the other, on a risk-adjusted basis, you're up almost double the performance of the latter. So value is very, very stretched. Now one can say, yeah, but you like energy. Within value, yes, but we don't like staples, for instance.
Small caps? International?
Yeah, fine, small caps are fine.
So it's still a diversified approach,
always,
just not tech. Finally, just to wrap it up, and then we'll get to our rapid fire rounds. You know, for our viewers who might be sitting in the S&P 500, you know, who might just have broad index exposure, who say, wait a minute, tech's not going to go anywhere. What does that mean for the S&P? Obviously, it's a big part of that. What's the takeaway for them?
For them is the way you started, the people that are sitting in it. They're buy and hold anyway, so just keep sitting.
Because eventually it will go up.
Markets go up 75% of the time. There are more Gillette razors being consumed in the future then, more babies. Yeah, the broad thrust of success of humanity, of America, of the S&P, sure. But if they're just sitting in it, keep sitting.
And what would make you overweight tech again?
That's interesting. It would be the semis truly putting in a bottom that's enduring, right? Now, after that run up and that collapse, they look to be sort of dull here, like range bound, and not making new lows. And then a pulling in some of the overdone Twofold. Within software, the ones that have shot the moon, like Microsoft, pulling in, and the ones that are still coming to life that are sort of developmental, like a Roper, starting to continue to improve.
What's a tech chart that still looks strong to you that might buck the sideways trend?
You mean well, again, if you had to be biased, you had to be directional. I think NVIDIA, which is at a 4-year relative low or something like that to software, at the semis at the peak, I think you play that long. If you want to be directional, we would prefer to wait for the play and strangle it.
Okay, all right. A good time to pivot to our rapid fire round of this or that. This is your first time playing. Quick questions, quick answers, no hedging. You ready?
No, I don't hedge. Go ahead.
All right, here we go. Rally, healthy or unstable?
The current rally, I would say I would put it in unstable category.
Volatility, opportunity or warning?
Always an opportunity because of long short.
Market leadership, broadening or narrowing?
It has broadened.
Stretched winners, keep running or come back to earth?
They've already all come back to earth.
One name that's still overstretched?
Dell.
One that's run far that you'd still bet on?
Bank of New York, BNY.
Tech from here, software or semis?
Software.
But really neither because you're
really
underweight tech, or we should say. Oracle, Adobe, or Salesforce?
Salesforce.
Mega cap tech, chase or wait?
The whole theme, chase or wait? Wait.
Mag 7 with the healthiest chart?
Healthiest within Mag 7? Amazon.
Mag 7 name with the weakest chart?
Microsoft.
Next 10% move in the S&P 500, up or down?
Down.
Better opportunity, buying breakouts or buying pullbacks?
Buying breakouts.
Better market tell, S&P 500 or S&P equal weight?
I'm going to long with this. Do you know that the S&P equal weight has outperformed the actual weight since inception? Always go with the equal weight.
Most overbought of the part of the entire market right now?
Yeah, there's nothing overbought. Well, let's say energy sort of refiners and in certain insurance stocks, Travelers, Allstate.
Most oversold part of the market?
We think utilities have come down to where they should bounce.
Unpopular opinion chart that you hate right now?
Tesla.
One word to describe this market?
Quiescent, surprisingly.
Stocks by year end, higher or lower from here?
Lower.
That's Carter Worth. Really appreciate it, Carter.
Thank you.
Thanks so much for shedding some light on your ETF and charts and your insights. That's Carter Worth, CEO and founder of Worth Charting.